Everyone is watching the investors who made fortunes betting on artificial intelligence and the spectacular losses that followed when those trades suddenly reversed. One name caught the internet's attention: Leopold Aschenbrenner, a former OpenAI researcher who built an investment firm around the infrastructure he believed advanced AI would require. The dramatic stories about leverage, enormous swings, and paper fortunes are irresistible. But many of the most specific performance claims circulating online cannot be independently confirmed from public portfolio filings. And that distraction hides a much larger gamble. Behind the market drama, the world's biggest technology companies are spending hundreds of billions of dollars on the physical machinery of AI. Data centers, advanced chips, power equipment, cooling systems, and networks. The question is no longer whether these companies believe in artificial intelligence. The question is whether AI can produce enough profit to justify what they are spending. Meta offers the clearest test. In its second quarter of 2026, Meta reported revenue of roughly $60.8 billion, an increase of 28% from the previous year. Management says artificial intelligence is improving recommendations and advertising performance across Facebook, Instagram, and its other products. But the other side of the statement tells a more complicated story. Quarterly expenses rose about 55% to roughly $42 billion. Free cash flow fell sharply to less than $800 million. And Meta now expects capital expenditures of approximately $130 to $145 billion for 2026. That does not prove that AI investment is failing. It proves that the final verdict has not arrived. Online financial advice often divides capital expenditure into two simple categories. Maintenance capital expenditure keeps the current business running. Growth capital expenditure creates new revenue. Under that explanation, if spending rises and revenue also rises, the investment must be productive. Reality is more difficult. Imagine a farmer purchasing twice as much land, more machinery, and a larger irrigation system. His harvest increases the next year. That sounds successful until you compare the additional crops with the cost of the land, equipment, workers, fuel, and financing. AI infrastructure works the same way. A taller revenue bar does not tell you whether the new investment created a good return. You must determine how much profit and cash flow the company produced after absorbing the cost. This is why investors should examine at least 4 measurements. First, revenue growth. Is demand expanding consistently, and can management explain how AI is contributing to it? Second, operating margin. If revenue rises while margins collapse, the company may be purchasing growth at an unsustainable cost. Third, free cash flow. After the company pays its operating costs and capital expenditures, how much cash remains for debt repayment, shareholders, and future investment? Fourth, return on invested capital. Is each new dollar producing an attractive economic return? Or is the company building expensive infrastructure mainly because its competitors are doing the same? These measurements matter because AI infrastructure depreciates. A data center is not one permanent purchase. Servers consume electricity. Cooling systems require maintenance. Chips are replaced by faster generations. Buildings must be staffed, secured, and connected to the grid. The spending can begin as growth capital expenditure and later become an enormous maintenance obligation. That is the hidden risk in the AI boom. Meta, Microsoft, Amazon, and Alphabet are not simply purchasing software subscriptions. They are constructing an industrial layer for the digital economy. Industry estimates suggest their combined annual capital plans are approaching $700 billion. If AI dramatically improves advertising, cloud services, scientific research, and employee productivity, today's spending could eventually look small. The companies controlling the infrastructure may collect returns for years. But the bearish case is equally important. What happens if AI models become cheap commodities? What if customers refuse to pay enough for premium systems? What if increasingly efficient software reduces the amount of computing power required? And what if a new generation of chips makes today's expensive servers obsolete before they have earned back their cost? Then, some of the largest data centers ever constructed could become monuments to expectations that arrived too early. This is the deeper lesson behind volatile AI investment funds. A concentrated portfolio can produce extraordinary gains when the market agrees with its thesis. When sentiment changes, leverage and concentration can turn the same thesis into a brutal drawdown. Both outcomes can be real. A fund can have an excellent year and still suffer a devastating month. A company can generate record revenue while its free cash flow deteriorates. A technology can transform the economy while many investors still lose money betting on it. So do not judge the AI economy from one investor's return. And do not judge a company by two rising bars on a finance website. Follow the money. Compare revenue growth with operating margins, free cash flow, capital expenditure, and returns on invested capital. Watch whether management's promised productivity eventually appears in the financial statements. Because Wall Street's most important AI story is not about who gained or lost billions during a single month. It is about whether hundreds of billions of dollars are building the next industrial revolution or the infrastructure for the next financial bubble. This video is educational and does not provide financial advice.